The Federal Reserve does not print less money to raise your interest rate. There is no lever, no throttle, no wire running to your mortgage. What it actually does is stranger. It pays banks to park their cash, 3.65% right now, risk-free. And that one number becomes a floor under almost every rate in the country. Running rates this way has cost the Fed itself more than $230 billion. Here is the machine, drawn piece by piece.
Start with the day this machine last made the news. July 29th, 2026. Kevin Warsh, 10 weeks into the job of Fed chair, announced a 9-3 vote to hold the target range at 3.5 to 3.75%. 3 regional Fed presidents, Beth Hammack, Neil Kashkari, Lori Logan, dissented. They wanted a quarter-point hike. But look at what the 12 of them were actually voting on. Not how much money to print. A pair of numbers the Fed itself pays.
Because the story most of us carry around is dead. The textbook said the Fed keeps bank reserves scarce, reserves being the cash banks hold at the central bank, and that banks multiply every spare dollar into loans, so the Fed can throttle lending by rationing the pile. That world ended after 2008, when crisis lending and bond buying flooded banks with trillions. And in March 2020, the Fed cut reserve requirements, the minimum banks must hold, to 0. Not lower, 0. Today, banks sit on roughly $3 trillion parked at the Fed. You cannot ration a flood.
So instead, the Fed controls the price of the flood. Every bank keeps an account at the Federal Reserve, and the Fed pays interest on those balances. The rate is called IORB, interest on reserve balances, and this August it pays 3.65%, risk-free. Now, sit at a bank's trading desk. Another bank offers to borrow your spare billions overnight at 3.4%. Why say yes? The Fed already pays you 3.65 for doing nothing. So you refuse. Every bank refuses. That refusal is the floor. Check the tape. On August 4th, the effective federal funds rate, the measured price of real overnight loans between banks, was 3.63%, 0.02 below the floor. That tiny gap is the machine's fingerprint. A few big cash lenders, mainly the federal home loan banks, are not allowed to earn IORB, so they lend just under 3.65 to banks that can, and those banks pocket the sliver in between. Competition keeps the sliver microscopic. Nobody decreed 3.63. Arbitrage, everyone chasing the same risk-free rate, holds it there. Money market funds can't earn IORB either, so the Fed offers them a second deal. Overnight reverse repo at 3.50%. Lend the Fed your cash, hold Treasury collateral, unwind it tomorrow. A second floor under the first. And up top, a bank that needs cash can borrow from the Fed at 3.75. 2 floors below, relief valves above. The market rate lives inside the band because every exit is priced. So here is what raising rates actually looks like. The morning after a hike, no trucks roll and nothing is printed. The board posts new numbers. Floor up a quarter point, second floor up a quarter point, and by the next day, every overnight dollar in the system has repriced against them. That is the entire event. A price change on parked money. From there, the ripple. Some of it wired, some of it loose. Prime, the benchmark for business lending, is pure convention. The top of the Fed's band plus 3 points. 3.75 plus 3 is 6.75%, usually reset within days. Credit cards are typically priced at prime plus a margin, which is how cards that carried a balance averaged 22.15% this spring. Savings accounts are the loose end. Banks raise them only when they need your money. The average savings account paid 0.61% this SAR. Online banks, hungry for deposits, paid around 4%.
And the mortgage? The Fed does not set it at all.
A 30-year mortgage prices off the 10-year Treasury yield, about 4.6% in early August. And that yield is the market's bet on where the Fed's floor will sit over a decade, plus inflation, plus a premium for waiting. That is why mortgages averaged around 6.7%, while the Fed's overnight rate sat near 3.6%. It is also why mortgage rates can move on a day the Fed does nothing. The bet moves, even when the floor doesn't. One more thing, and it is the strangest part. This machine sends the bill to its owner. The Fed earns interest from a bond portfolio it mostly bought when rates were near zero. It pays interest on $3 trillion of reserves at today's floor. After the 2022 hikes, the payout raced past the income. In 2023, its interest bill hit $281 billion, while the portfolio earned far less, and it has now lost money 3 years running. The running total? About $233 billion as of July, which the Fed books as an asset, a deferred asset. Future profits it must earn back before it resumes paying its profits to the Treasury. That pipe used to carry about $100 billion a year. It has been mostly shut since September 2022. A few profitable regional Feds have restarted small payments, but the big stream stays off until the hole is filled. A central bank cannot go bust the way a company can. It creates the money it pays with, and rate control keeps working either way. But the cost is real. Every year the pipe stays shut, the Treasury collects less, and the public debt sits a little higher than it otherwise would. That is the price of setting rates by paying for them. Which brings back July 29th. Read it again, knowing the machine. 9 votes to hold the floor at 3.65. 3 votes to lift it a quarter point, from officials arguing inflation would not come home on its own. Within a week, markets went from calling a September hike near certain to calling it a coin flip. Whatever the committee decides next, the move itself will look exactly the same. No press, no lever. One number on 3 trillion parked dollars, and every rate you pay standing somewhere on top of it.